Tesla CEO Elon Musk tweeted out Monday afternoon that he would be on his company's coming fourth quarter conference call, which will happen around late January. Tesla's third quarter earnings are coming and investors are expecting a blowout number as they bid the stock up, almost to an all-time high. Analysts are bullish about the quarter two, but are raising their numbers ever so slowly ahead of Wednesday's release. Investors need to be aware of the mismatch between expectations and analyst estimates to judge the quality of any Tesla earnings beat or miss. Tesla stock, after all, has risen about 12% since the electric vehicle company reported earlier this month delivering about 241,000 vehicles in the third quarter. That was a roughly 20% increase in unit sales from the second quarter and 10,000 to 15,000 more vehicles than analysts were expecting. Strong deliveries have helped the stock. Shares closed at $870.11 on Monday, gaining for a sixth consecutive day. That puts the stock within about 3% of its all-time high of $900.40 set back in January. Strong deliveries also have analysts changing numbers. Citigroup analyst Tsla Michael raised his estimates ahead of Tesla's quarterly report. His third quarter earnings estimate is now $1.89 a share, up from $1.66. For 2021, Michael expects Tesla to earn $6.35 a share, up from a previous estimate of $5.77. He raised his third quarter number by 23 cents. Overall, analysts have bumped up third quarter earnings estimates by about 20 cents to about $1.67 a share since Tesla's delivery numbers were released. Despite the larger than average increase, Michael isn't a Tesla bull. He rates shares selling as a $209 target price on the stock. Looking into 2022, Michael expects Tesla to earn $7.34 a share, up from his prior estimate of $6.98. His peers are projecting $7.44 in 2022 per share earnings, up from about $7.19 a month ago. This coming year's estimates are up about 3% over the past month. That's small given improving deliveries, but analyst numbers tend to move up or down slower than investors react to news. That makes some sense. There are almost 50 analysts that cover Tesla stock. They all have their own ways of managing estimates. The average analyst price target moves slowly too. It has gone from about $666 to $669 a share since delivery results were announced. That's a 0.5% increase. The high end of analyst estimates for the third quarter is about $2 a share. That's a number investors can keep in mind to judge if Tesla stock will keep driving higher. That's probably bullish for Tesla stock in the short run. It might mean things are going well. It could be bullish in the long run too, depending on what he says. Tesla published a simplified account of the quarter along with its fourth quarter press release. The company's 10 Kelvin, filed Feb 19, and is the closest thing to a complete look under the hood that we outside investors can hope to get. Tesla is known to sugarcoat its initial earnings release, so the 10 Kelvin has become essential reading for anyone hoping for a warts and all view of the company. This year's filing did not disappoint. It is replete with red flags, as well as a few things that just do not add up no matter how we look at it. Padding cash any way possible. Tesla has a reputation for playing games with its accounting. That is not illegal by any means, but it does mean it can be harder to get a fix on the company's true financial health compared to other public companies. This year's 10 Kelvin was no different. Looking at the balance sheet, it looks like Tesla has managed to pad out its cash balance by nearly $500 million. This was apparently accomplished by holding off from paying state sales taxes, as well as choosing to change certain recognition standards to shift some items from accounts payable to other current liabilities. Tesla has been fighting to show it does not need external cash injections, despite virtually every analyst saying they have to do so. These sorts of balance sheet gimmicks can only get the company so far. Mystery fund investor liabilities. Another strange point involves a certain class of investors. Specifically, Tesla has guaranteed a certain level of return on investment to a group of funds. In its 2017 10 Kelvin, Tesla stated that it had achieved the necessary return. The 2018 filing fails to make any such mention. As Lewis Carruthers, a longtime Tesla watcher, has pointed out, lack of disclosure has created an unusual mystery liability. Tesla guarantees returns to certain fund investors, but doesn't reserve or disclosure scope around guarantees. 2017, Tesla claims investor achieved the specified rate of return. This year, no such claim, What's the exposure of the pendulum swinging? While it is unlikely to be a liability of great significance, the very fact that it exists is cause to ponder. Regulatory questions in Shanghai. Tesla has been talking up its Shanghai factory for the past few months, promising repeatedly to begin production at scale by the end of 2019. We have already addressed how the proposed timeline makes no sense and defies all industry best practices, so that needs no repetition here. For all its posturing and grandstanding, it appears the factory plan has yet to receive regulatory approval. We broke ground in January 2019, and subject to a number of uncertainties, including regulatory approval, supply chain constraints, and the pace of installing production equipment and bringing the factory online, we expect to begin production of certain trims of Model 3 at Gigafactory Shanghai by the end of 2019. A groundbreaking is easy, building a factory is not. Tesla has essentially admitted that it must still go through a regulatory approval process. This should have been obvious if one observed the timelines of top-tier automakers' factory developments. Tesla's timeline was always fanciful, but this latest disclosure adds yet another potential roadblock. Trouble counting cars. Tesla's principal business is making and selling cars. It does not use dealerships, so all sales of new vehicles are handled internally. Thus, one might think that Tesla would have a clear handle on the number of cars it sold in 2018. Yet, a review of its 10 Kelvin reveals that the numbers do not add up. The 10 Kelvin states that combined sales of the Model S and Model X fell by 3,240 units compared to 2017. In its 10 Kelvin for 2017, Tesla reported 101,420 combined deliveries of the Model S and X, as well as 1,764 of the new Model 3 sedans. Yet, if we look at the total reported vehicle deliveries and the number of Model 3 seconds delivered in 2018, we end up with a different number for the Model S and X. Indeed, by simple subtraction, we find a sequential decline in deliveries of the Model S and X of just over 2,000 units. This is no small thing. At a $100,000 average sale price, that is more than $100 million in potential revenue that has apparently dropped off the face of the earth. Verdict: Tesla's financial and operational stress will continue to mount in 2019. As the year plays out, the company will come under increasing pressure to disclose information it has thus far tried to keep close to the vest. The latest 10 Kelvin is revealing insofar as it demonstrates once again that Tesla tends to be slapdash in its reporting. These latest red flags, both big and small, could end up causing operational, legal and financial headaches for the automaker even as it fights for survival and relevance in the face of both an increasingly competitive landscape and a harsher macroeconomic environment. This is all for today, folks. If you enjoyed this video, then leave a like, and if you are new, then don't forget to subscribe.